All right, if you think you can't build real wealth during a bad market, this video is going to change how you look at investing forever. Now, 2 weeks ago on this channel, I showed you guys this portfolio was at $178,000. Today, it's sitting at $182,481. And important, this is during a drawdown with volatility everywhere. Headlines are screaming fear, sell everything, the market's going to crash. Okay, well, I'm going to break down exactly what's in this account, why my returns look slower than people expect, and why I'm temporarily using a margin strategy, and how this portfolio is positioned to explode when the market turns back up. Now, this is not hype. This is real money, real strategy, and full transparency of my portfolio. Before we get into it, quick disclaimer, this video is for educational purposes only. This is not financial advice. I'm not a financial advisor. This is just me showing you exactly what I'm doing with my own personal money so you can make better decisions for yourself. All right, now let's start with the actual numbers so there's no confusion. And it's best just to be open and transparent about this stuff. So the current portfolio value is $182,481. Like I said 2 weeks ago, it was at $178,000. So that gives roughly a $4,500 change in 2 weeks. Total profit $8,800 or 5%. Daily move today is up $2,500, and annual dividend income of $2,478. Now it shows the IRR, or my rate of return, 10.29%, which is low right now because the market's in a downturn. It usually sits around like 18 to 22%. That $4,500 it matters because it happened during a rough market and it's not during like a straight up bull run. So that's actually a really good thing. Now let's address the elephant in the room. Like, why don't my returns look higher? Well, here's the truth for that. Like I said, the market has been in a drawdown pretty bad for the last week, give or take. I'm tech heavy. Tech gets hit harder during times of uncertainty. We have everything going on with the rate cuts with the Fed right now and with all the AI stuff. But when tech is flying, this portfolio outperforms. When tech pulls back, this portfolio is going to feel it more, and that's intentional. But I'm only 40 years old. I'm young. I'm in this for the long haul, and I've got lots of really good holdings in here. So Nvidia, Microsoft, Meta, Broadcom, QQQ, SMH, VTI, some momentum ETFs. These are long-term growth engines. They're not short-term safety plays. I'm not building a portfolio for comfort. I'm building one for scale and for long-term. You'll also notice something that scares a lot of people, and that's going to be a negative cash balance of just over $9,000 in this account. That's not a mistake. That's the margin, and that's why I'm using it right now. So you guys know that I typically put in like $5,000 to $7,000 a month contributed into my portfolio. I pulled a $10,000 margin. Why did I do that? Well, the market is down right now. Quality assets are discounted. I want more exposure before the recovery happens. This is not a YOLO margin. This is on purpose. This is controlled, and it's temporary leverage. I have a few rules that I abide by when I'm using this. I only use small margin relative to the account size. I pay it back very quickly, often within the same month. That way I can avoid long-term interest drag. I typically will pay no interest or very, very minimal interest because I'm paying my margins back so quickly. Think of it as a bridge, not a crutch. Typically I do $2,000 to $5,000 of margins. Since we're in such a drawdown right now, I went big and went 10,000. Here's the part that most people miss. I don't just pull the margin and let it sit. So I roll the margin. And how a rolling margin works is there's a market dip. I deploy a small margin. I add capital, or I let prices recover. I pay back the margin, and I repeat this only during drawdowns. I don't pull margins during bull runs or anything. Now, this keeps me aggressive when fear is high and conservative when prices normalize. Most people do the opposite of this. They get aggressive at the tops and they get scared at the bottoms. Even though this is a growth focused portfolio, it's still generating income. Not a ton, but some. So $2,478 annually, or roughly $206 a month, with a dividend growth of 13% over 5 years. So I'm getting $200 a month just in dividends, which that's nice. It's not life-changing money, but this income helps offset volatility. It gives me some flexibility, especially during flat markets. I reinvest those dividends anyways. I don't pay myself from them. But this is not about short-term returns. This is about positioning for long-term growth. So when the market turns, and it always does, as we know based off of history, tech-heavy, aggressively accumulated portfolios like this, they don't crawl back upwards. They snap upward, and they do it pretty quickly. That's how you go from $182,000 to $300,000 to $500,000 to $1,000,000. Slow markets build fast portfolios if you know what you're doing. Now, if you want real transparent updates, the wins, the drawdowns, the strategies, mistakes, because I'm going to make them, make sure that you subscribe to this channel. This is a new channel that I put out for you guys. I'm having fun with it. I'm hoping to grow it as quickly as we can. This is a long-term road, and I'm documenting my entire journey to reaching $1 million on this portfolio. I appreciate you guys being here from the beginning. Drop some comments down below. Say hi. Let's get to know each other. I'll see you guys in the next update.